We have a lot of ground to cover today. It's an ambitious schedule. So we're going to start with an overview discussion about the nature of this crisis compared to the financial crisis in 2008, the legislative response that Congress has given us with respect to elements of this crisis that covers different industries, different kinds of programs. We're also going to talk about the separate but interrelated Federal Reserve response with a series of programs that they have put in place or are putting in place. Then we'll move into some specific areas that interrelate to that and follow up with a discussion of how these programs should be viewed by participants in a number of different key industries. Most of these programs that we're going to talk about are not fully fleshed out at this point in time. There's a lot to come yet, rules, regulations, interpretations that will follow on. And so as we discuss these things, in many cases, we'll be quite general, but the specifics should be to come. Also, a number of the programs we'll talk about with regard to industries may not fit into a standardized pattern, and they're likely to be quite bespoke with respect to the companies and industries covered. And that will be reflected in the discussion that we're talking about. Nonetheless, notwithstanding this need to be general, we would urge companies that are thinking about this really to seize upon the moment now to plan for how they may utilize these programs. If you're sitting around now and saying, you know what, this crisis may be a problem for me, but I don't know if it will be. I don't know what I'm going to be doing in 2 months. It's really time now, nonetheless, to start planning for what you might need and moving forward with that, both planning for what you might do and then thinking about how to approach government agencies with respect to it, because many of these programs have a time limit. There are only a certain amount of funds, and I don't know whether they'll run out, but with respect to the PPP at least, which we'll talk about, the Secretary Mnuchin already suggested if it ran out, he would go back to Congress, and he will need to go back to Congress for further money. So the other element to think about is we'll talk about how many of these programs have conditions attached to them, and you may want to think about how those conditions affect the desirability of these programs, and there are trade-offs among the different ones, and we'll talk about those. Let me just start, though, turning to my partner, Audrey Cohen, who's the senior chairman of our firm, and who was described recently as one of the 3 or 4 constants between the financial crisis and this crisis. He always seems to be present. So I was going to ask him to start out by comparing the 2 situations and the government responses in respect of them.
Well, thank you, Mitch. And let me begin by echoing your comments at the very beginning. Our best wishes for all of you who are attending in our entire country. This is a very different crisis than 2008. It will have different consequences and therefore demands different remedies. Let me begin with 2008. That was a crisis that began in the financial services industry and spread to the broader economy. This, of course, now is a crisis that at its origin is a health crisis that has caused severe economic disruption, and that in turn places pressure on the financial system. As a result, the remedies which Congress and the various governmental agencies have chosen this time differ substantially. 2008, you saw most of the remedial actions being directed to individual financial institutions. And when those proved unavailing to prevent contagion, there were broader financial services programs initiated. but actually relatively little for the economy as a whole. And that was one of the real criticisms of the remedial actions taken in 2008. This time, the programs which Congress has enacted, predominantly the CARES Act, are directed to the broader economy. Certainly, there were some initial Fed programs which were directed to the financial services industry, and Tom Baxter is going to describe them, both to do what I call cleaning the pipes, making sure transactions could flow, and then avoiding a severe disruption in the credit markets, particularly the short-term credit markets. But the CARES Act, again, is addressed to the broader economy. Mitch, if I could continue what is, I think, now critical, because I want to pick up on a just fundamental point you made. What is now of great importance is to operationalize these programs. They are there. There is an awful lot of money which is available now for the broader economy, but it needs to be operationalized. There will inevitably be a conflict between effectiveness, protection of the taxpayer on one hand, and getting it out quickly on the other. But the first two cannot overcome the third. And to give an illustration, the Paycheck Protection Program, which was rolled out very promptly, very quickly by Treasury and SBA, has started the process. It is not perfect. Nothing ever will be. There are questions which are unanswered. There will always be. But right now, again, thanks to Treasury, thanks to the SBA, there is a program out there and operating. And to me, that is the model.
Thank you, Raj. When you think about, how these, so Tom's going to pick up with a discussion of the Federal Reserve programs, but obviously they interrelate. There's money that goes back and forth. How do you see, as to operationalization and the other things you talked about, the cooperation between the Treasury, the Fed, the SBA, and all rolling forward?
Sure. Well, it may be helpful to outline the programs which remain available under the CARES Act for money to flow to the business community and also to the states and municipalities. And I would really divide those into 6 programs. And then I will come back and try and talk about operationalization in each case. The first is for, and these are, let me call them B1, B2, B3, B4, A, B, and C, because that's where they are pretty much in the statute. B1 is for the air passenger carriers and related industries. That is one which I believe Treasury is far down the road. I would be surprised if it is not rolled out this week. These will tend to be bespoken programs. In other words, individual loan arrangements or grant arrangements for individual borrowers or recipients. Next, B2 is air cargo carriers. B3 is for industries essential to the national security. B2 and B3 are also likely to be largely bespoken programs. And just again, to echo a very critical point Mitch made, if you think you could qualify for B2 or B3, I would not be waiting. I would be talking to the government now. B4 is the vast pot of money. That is $454 billion, which everyone believes will be leveraged with Federal Reserve money under 13.3 of the Federal Reserve Act And how much the leverage factor will be remains unknown, but I think one can assume with accuracy that the amount will be trillions, not hundreds of billions. B4, the basic B4, which I'll call B4A, is sometimes referred to as Main Street lending. And Main Street lending is for small and mid-sized businesses. There may be more flexibility, but right now it should be from 1 employee to 10,000 employees, because the 500 to 10,000 is mid-sized, small is presumably everything lower than 500. The B5 or B4B, as I refer to it, is for everybody else who's not covered, who's a business, and that can be 10,001 employees and over. And then B4C is states and municipalities. It is likely that the vast bulk of the money will be in Main Street lending, and that is going to be a critical operational question. Will those be uniform programs like PPP, or will they be bespoken programs? Everyone over 10,000 employees and states and municipalities could well be bespoken. The danger with bespoken programs from the 1 to 10,000 employees is that it would take so long to get up and running.
Thank you, Raj. Before we move on to the Federal Reserve programs, let me stay with the CARES Act and ask Sam Woodall, who's our legislative commander-in-chief in Washington. Sam, I remember, Schoolhouse Rock and I'm Just a Bill and How I Become a Law. And given the circumstances under which this legislation, came into being, the lessons I learned as a child probably don't hold true. What was the process really like?
So I think you could probably sing the first part of that tune. There is just a bill here, and then skip to the end where the president signs it, because nothing else in between happened the way it was supposed to. This in many ways was more challenging than TARP, Dodd-Frank, and the Patriot Act combined. Obviously for lawmakers and their staff, but also for those of us on the outside who were trying to figure out what was going on. There was no regular order. There were no hearings, no markups, no committee reports, and basically Congress, which is not a body that is built or was intended to be built for speed, was forced to act in record time. And then, to complicate everything on top of just the exigency of it, you had the COVID-19 situation that was that made the logistics here very difficult. You couldn't gather in a single war room like they did for TARP. Instead, there wound up being several mini war rooms in the Capitol where Senators McConnell, Schumer, some of their colleagues, Treasury, White House, and others were meeting and then shuffling back and forth between those rooms. In the meantime, as I'm sure everyone knows, there were several lawmakers that were sidelined altogether because of COVID. Either they had contracted the virus or they were self-isolating. But to kind of get back to the Schoolhouse Rock, you can't entirely sidestep the Constitution or the rules of procedure here. So there was just a bill. It turns out in this instance, it was a House bill that had nothing to do with COVID. It was introduced in January in the House, and that was to satisfy a constitutional requirement that spending bills like this originate in the House. So they picked up this House bill, turned it into a shell, procedurally speaking. And so most of those votes that you saw in the Senate up until the end were actually on a different piece of legislation. So
the next question is, is phase 4 or stimulus 4 something that we foresee actually happening, and when?
Yeah, I think so. I would just say, and this touches on something Raj picked up on, as messy as this process was and as imperfect as the legislation is, I do think, at the risk of complimenting Congress, which never seems to be fashionable, I think it's remarkable not only that they passed it, but that they passed something that is really hangs together as a coherent package. When you look at it if you take a few steps back, it's a remarkably thoughtful construct. In terms of what phase 4 is going to look like, there was initially a lot of talk about making this an infrastructure bill. I think the conversation has gravitated now to more of a CARES Act 2 bill that will build on the existing programs, probably appropriate significantly more money for some of these, and maybe clean up some of the imperfections that we talked about earlier.
Thank you. So having talked about the legislation and the legislative responses, let's turn now and ask Tom Baxter to talk about the Federal Reserve programs and its responses.
And thanks very much, Mitch, and thank you everyone for listening. I hope you're all staying safe and your families are well. With respect to the Federal Reserve Program, for over 100 years, central banks around the world have responded to financial crises by injecting liquidity. And the Federal Reserve has been injecting liquidity in response to the coronavirus crisis. It's been doing it through an exercise of its monetary and its lending powers. So with respect to the monetary powers, you've seen the Federal Reserve inject liquidity by buying government securities and agency securities and essentially causing all boats to rise with the rising tide of liquidity. And we're not going to talk about the Federal Reserve's monetary powers today. We're going to focus on the Federal Reserve lending powers. And the basic lending power of the Federal Reserve is to lend to banks during normal times. And that's done pursuant to Section 10B of the Federal Reserve Act. We're not going to talk about that standard Federal Reserve lending because that's not really the focus of our discussion this morning. Instead, we're going to focus for the Federal Reserve's emergency facilities that are done under a different provision of the Federal Reserve Act, Section 13.3. And Section 13.3 contemplates Federal Reserve lending powers to a broad group of eligible participants. And so we're going to focus on that specific type of Federal Reserve lending in our discussion this morning. Before the CARES Act was enacted, the Federal Reserve announced 7 different emergency lending facilities. And we're going to go through them very quickly. The first is the primary dealer credit facility, designed to inject liquidity into the market for government and agency securities through the Fed's primary dealers. The second is the commercial paper funding facility. And as the name implies, it's a liquidity facility directed toward the commercial paper markets. The third emergency facility is the money market mutual fund liquidity facility. And that's designed to deal with a situation where there are redemptions in money market mutual funds and those funds needing dollar liquidity. So this particular program is designed to get them that needed liquidity. The fourth is the Term Asset-Backed Securities Lending Facility, also known as the TALF. That's designed to provide liquidity to asset-backed securities markets. Now, I've named 4 emergency lending facilities so far in my remarks. All of these facilities have been brought out to address the coronavirus crises, and they're similar to facilities that were used during the crisis our country experienced from 2007 to 2009. So we have those 4 emergency lending facilities. We also have 3 new facilities that the Federal Reserve has announced. One is the primary market corporate credit facility, a program where the Fed will lend to a vehicle and that vehicle will use those loan proceeds to acquire investment grade bonds from a seller. The second facility that comes under the heading of new Federal Reserve facilities is a secondary market corporate credit facility. And in this one, the Federal Reserve will lend to a vehicle which will acquire investment-grade bonds in the secondary market, not from the original issuer. And then the third of these new facilities, announced by the Fed before the CARES Act was enacted, is the Main Street Lending Program that was referenced by Raj in his opening remarks. So we've got 3 new facilities in addition to 4 facilities that were seen during the last crisis, for a total of 7 facilities announced by the Fed using its emergency lending powers under Section 13, subparagraph 3 of the Federal Reserve Act. I want to just emphasize that for a minute. All 7 are being announced and brought out by the Fed pursuant to authority other than the CARES Act. This is pursuant to Section 13, subparagraph 3. The Main Street Lending Program is a little bit different in that the Fed announced it before the CARES Act was enacted, but has not really gone further and told us what the details will be in that program. So in sum, we've got this 7 new programs that were announced by the Federal Reserve, all targeted at specific markets in the United States that the Fed saw a special liquidity need. Let me address one of the frequently asked questions about the Federal Reserve programs, and that relates to restrictions. The CARES Act contains restrictions with respect to limitations on the ability to pay dividends, to do share buybacks, to do certain forms of executive compensation, and to address your workforce. So a number of restrictions exist in the CARES Act. Many raise the question, do those restrictions apply to the Fed's 13.3 programs? So in answering that question, you start, of course, with the words of the CARES Act, and there is a specific reference in the CARES Act called direct loans. And if you look at the definition of direct loan, you'll see that the Federal Reserve broad-based facilities, which are not done pursuant to a bilateral loan agreement and often relate to a Fed vehicle engaging in a securities or capital market transactions, don't fit within the definition of direct loan. Second is there's a savings provision in the CARES Act that says that nothing in the CARES Act limits the Federal Reserve with respect to 13.3 programs. The Federal Reserve programs that I mentioned in this alphabet mix of facilities are all done pursuant to 13.3, and there's that specific savings provision. In addition, within Section 13.3, there is a specific provision that requires the Federal Reserve to report to the Congress. And among the things the Fed is required to report are any restrictions on participants in any of the 13.3 programs. The statute goes on to name some of those restrictions, like restrictions on dividends and restrictions on buybacks. That's right in Section 13.3. And with respect to several of the Federal Reserve programs, the Federal Reserve has said in 13.3 reports to the Congress that the restrictions on dividends and buybacks do not apply to those Federal Reserve programs, the 6 other than the Main Street Lending Facility, with one significant exception. If you look at the report done on the primary market corporate credit facility, you'll see that exception. And it says if a participant elects the pick option under the primary market corporate credit facility, then it cannot pay dividends or purchase its shares for the duration that it is exercising the pick. So you have one exception across 6 programs announced by the Federal Reserve under Section 13.3, and it relates to a very specific limitation on your ability to pay dividends or to do share buybacks while you're exercising the pick option. Now, the remaining program, the Main Street Lending Facility, we don't know the answer with respect to what requirements will apply because the Fed has not yet done its 13.3 report to the Congress. So that remains open. That is also a facility that is expressly named in the CARES Act. And so we're watching for further detail with respect to how that program will operate and what restrictions will be applied to it. Mitch, I hope I've been able to cover in my 10 minutes those Federal Reserve programs and the restrictions that apply to them.
Yeah, thank you, Tom. After having heard Raj, Tom, Sam, Raj yourself, Tom and Sam, talk about the breadth of the response, Raj, perhaps in a couple minutes you might have some further thoughts on comparison of the reaction, the boldness and expansiveness of the government response.
Well, sure, Mitch, and very quickly, this set of programs, both from the Federal Reserve and from Congress, far surpasses what was done in 2008 in terms of dollars and in terms of breadth. And to return to my earlier remarks, that is appropriate because of the nature of this crisis. I have heard it quoted that one former senior official from 2008 said something like, we could only have dreamed of being as expansive as this set of programs is. And I think he was right to have dreamed then, but it has become reality now.
Thanks, Raj. Let's turn now to Rebecca Simmons, who's going to talk about one of the programs that is just rolling out now, but is much more operationalized in a sense than the other programs we've talked about. So it's perhaps an example of what's to come with regard to at least some of the programs. Rebecca?
Thank you, Mitch, and I will add my words to the chorus of good wishes to all. I'm going to talk about, as Mitch said, the Paycheck Protection Program, which is intended, as its name suggests, to allow employers to retain and pay their staff, even if the employer and the employees in question are not able to work or to carry out their business. It allows employers to obtain loans based on their prior year's payroll in an amount equal to the lesser of about 2.5 times the pre-crisis payroll and $10 million. So there's an overall cap of $10 million per loan. And for each company, the loan is limited to approximately 2.5 months of the company's pre-crisis payroll. The total program is $349 billion, although that $349 billion actually does need to be shared with some other SBA programs under the statute. Nonetheless, there is an expectation that near that amount of money will be applied to loans under this program. To borrow, a borrower has to collect and calculate 2.5 months of payroll payroll costs as defined in the statute, and focus on that first because there are a couple of adjustments to what constitutes payroll. First of all, salaries and wages and amounts paid to independent contractors on and reported on Form 1099 are included within the definition of payroll, but so are some other related costs like health insurance premiums and similar costs. There is a cap on the amount of payroll for any individual employee that can be addressed by the program or included in the loan amount of $100,000 for each employee. That does serve to cut back a little bit from the payroll cost that can be used to calculate the amount of the loan. But overall, it's a question of assembling, the borrower has to assemble records and provide information and certify that the amount of the loan that it's requesting is no greater than that 2.5 times multiplied by those qualifying payroll costs. The proceeds of the loan can be used for payroll from interest, but not principal on mortgages, for rent, and for specified utilities. there have been some discussions about whether the definition of utility should be expanded somewhat to reflect some of the types of utilities, such as cloud service, that businesses do rely upon, but at this point, it's a specified list. The term of the loan is a 2-year loan, and the interest rate is 1%. And the Treasury has, the SBA has indicated that those terms will be the same across all loans. Interest and principal payments are deferred for at least 6 months under the terms of the program. And one of the key elements of this program, and the reason one of the reasons people are so eager to obtain these loans, is that the borrower can request forgiveness of the principal amount of the loan if the borrower can demonstrate that the proceeds were used for payroll and other permitted costs, and forgiveness will apply to the extent it was used for payroll, and up to 25% of the principal amount could be forgiven if it was used for the other permitted purposes. These uses have to be completed by June 30th. And forgiveness is not automatic. That is actually one important point. Borrowers must apply for it, and they must prove that they used the proceeds for these permitted purposes. That's important because both from the perspective of the banks, who need to process these forgiveness requests and pass them through to the SBA, but also for borrowers, because failure to request forgiveness coupled with failure to start paying the loan can bar a borrower from future participation in SBA loan programs and some other benefits, and may have other consequences to the borrower. So the complying with the application process will be important. The banks and the SBA and the Treasury all have been working extremely hard over the last week and a half to get this loan, and longer actually, to get this program up and running. I think we all know that there has been a fair amount of frustration expressed by borrowers that the funds are not already flowing. And frankly, I think that frustration is shared by everyone involved in the program. I think the importance of this program to getting the money flowing to Main Street, as we all like to say, is clear. And yet, it turns out that there are a number of operational difficulties that have arisen with respect to the program. One issue, of course, with $349 billion flowing out the door on these terms, there is some concern about applications that may not be entirely honest or may not be accurate. And one of the issues that has taken a great deal of time over the last week has been how to address that risk. I think both the banks and the government are focused on getting the money flowing, but they want it flowing to where it should be going. So there has been almost endless work by all parties concerned to develop new policies and procedures, to develop new systems, and to make sure that the program operates the way it's intended to operate. There are also systems limitations. When it's important to realize that we're trying to, that there's an attempt to get out the door an enormous amount of money, which will be in the form of hundreds of thousands of small loans. I hadn't realized that the total number of loans made by the SBA in a year was under $35,000, 35,000 loans in prior years, and the total amount was under $40 billion. So we're talking about a multiple in terms of both the number of loans and the amount of loans being distributed. That has led to some really severe logjams in the technological and operational procedures at both banks and at the SBA as they try to process the enormous number of loans required to be completed. There have been some hiccups in terms of agreeing on a form of application, but that has now been settled. There have been some discussions around what procedures need to be followed by the banks with respect to those applications before forwarding them on to the SBA. Further guidance is being provided on that on an ongoing basis. There are also a number of questions because the eligibility for this program actually goes beyond the small businesses who are able to participate in normal SBA loans, the regular SBA programs. So those questions have related to such things as what business lines are eligible, what types of nonprofits are eligible. There have been a tremendous number of questions around the eligibility of houses of worship and related entities, questions around the application of some of the special exemptions that were included to protect especially vulnerable industries. For example, the statute eliminates some of the restrictions on affiliation between borrowers in terms of determining whether somebody is a small business that are applicable to franchise businesses and particularly to restaurants. And so all the parties concerned have been working these issues through. The programs are beginning to come online. Some banks have begun to accept applications. The SBA should be able to start receiving those applications soon, if not already. They were working on that yesterday. And I think we all expect to see funds flowing in the coming weeks. There is a worry, and I think it was exacerbated a little bit by the press and the commentary on these programs, that the funds will run out. And so there has been almost a frantic or panicked effort by borrowers to get their applications in before it's too late. That has 2 points I would just note. One, as Mitch said, there is already talk of authorizing further funds for the program. We'll have to see whether that happens. But I think the SBA had some confidence that given what payrolls for small businesses, even taking into account the broader availability over prior years has been, the $349 billion should be sufficient to cover the 8 weeks of pay that can be paid with the proceeds of the loan, or forgiven with the proceeds of the, if paid with the proceeds of the loan. And secondly, this does have the unfortunate side effect because of the way the statute was written. Potentially, if there is not further funding authorized, potentially leaving those companies that cannot use the funds in the short term to apply under whatever new funding might be available. The funds must be used promptly within 8 weeks after disbursement of the loan in order to achieve forgiveness, and that does put some pressure on people to both receive the loans and apply them promptly. So I think that outlines the major elements of the loan, Mitch, and I think I'll pause there and come back if there are questions. I think you're muted.
One thing I can promise you based on the questions I'm seeing, which we'll come to after the formal part of our program is complete, is there will be a lot of questions for you about the PPP. It continues to be a source of interest among the wide range of our clients. Camille, we're going to turn in a few moments to sort of questions about how industry players should be viewing the challenges, opportunities, and other elements presented by the various programs we've talked about. These are about providing new credit or new money to companies, businesses that are affected by the COVID crisis. But it's true, I believe, that there are other actions that bank regulatory agencies and other governmental entities have taken to try also to help with the reformation, renegotiation, or just deferment of payment on existing credits. And I wonder if you'd take a moment to talk about that.
Sure, Mitch, thank you. We have seen actions from federal and state banking and other regulators, as well as provisions of the CARES Act designed to give bank lenders flexibility in dealing with their borrowers. Some, like general statements of shifts in supervisory priorities or encouraging financial institutions with COVID-19 affected borrowers, are very general, but there are some specific technical changes that have been adopted as well. The CARES Act itself provides for 2 types of relief for banks in dealing with borrowers. The first modifies the accounting and reporting obligations for troubled debt restructurings, or TDRs, and the second allows for the optional delay of the implementation of the current expected credit loss methodology, referred to as CECL. Each of these measures is intended to make it easier for banks to be responsive to lenders experiencing crisis-related difficulties. Starting with TDRs, under U.S. generally accepted accounting principles, a restructuring of debt constitutes a TDR if the creditor, for economic or legal reasons related to the debtor's financial difficulties, grants a concession to the debtor that the creditor would not have otherwise considered. Under U.S. GAAP, any loan modified in a TDR is treated as an impaired loan, which has to be evaluated under applicable accounting standards, including measuring impairment and determining whether to record a charge-off or establish reserves. Classification of a loan as a TDR must also be reflected in an institution's regulatory and financial reporting. Before enactment of the legislation, the banking agencies, the NCUA, and the Conference of State Banking Supervisors issued, along with the CFPB, issued a statement encouraging financial institutions to work with borrowers who were affected by COVID-19, assuring that the agencies would not criticize institutions for working with borrowers, and stating that they wouldn't expect supervised institutions to automatically categorize all COVID-19 related loan modifications as TDRs. FASB also issued a statement concurring with this approach, which is important because it's an accounting standard that was established by FASB. Under the legislation, beginning on March 1st, a financial institution can elect to first suspend requirements under GAAP for loan modifications related to the coronavirus outbreak that would otherwise be categorized as a TDR, and second, suspend any determination of a loan modified as a result of the effects of the coronavirus outbreak as being a TDR, including impairment for accounting purposes. So what? The purpose of the measure is to allow bank lenders to enter into forbearances and modifications with borrowers affected by coronavirus without suffering adverse accounting and, by extension, regulatory capital consequences. So directly responsive to concerns, it gives banks the flexibility to work out loans and deal with borrowers affected by the pandemic without experiencing immediate negative effects on the income statement. The relief's not unlimited, but it includes actions related to a forbearance arrangement, an interest rate modification, a repayment plan, or any other similar arrangement that defers the payment of principal or interest on the loan that occurred due to the impact of the coronavirus emergency. That's one of the technical steps that was taken. And again, initially the banking agencies, along with the other agencies that I mentioned in FASB, gave guidance saying, they were looking at this, but the legislation provides specific relief related to TDRs. Turning to CECL, a little bit of background. In June of 2016, the Financial Accounting Standards Board introduced a change to the methodology for estimating allowances for credit losses from something called the incurred loss approach to the current expected credit losses approach, or CECL. The change, which has been controversial from the outset, requires banks to apply a forward-looking approach to recognizing credit losses on financial assets based on the expected credit loss over the life of the asset. For many SEC reporting companies with fiscal years ending 12/31, the CECL method became effective in the first quarter of 2020. Obviously, the timing was very challenging here. As I mentioned, CECL has been very controversial since its introduction, and banks have warned that CECL would have a pro-cyclical effect, making it harder for banks to lend during stress times. In the current situation, some banks had expressed serious concern that the application of CECL could affect banks' lending capacity and may have the perverse disincentivization for lending because it requires banks to set aside capital for potential losses over the life of the loan. Responding to industry concerns, the CARES Act includes a provision that gives banks the option of delaying implementation of the CECL methodology until the earlier of the date the coronavirus emergency terminates in December 31st of this year. The banking agencies also issued regulatory relief on March 27th, the same day, that allows banks that do adopt CECL in 2020 to delay the estimated impact of CECL on regulatory capital for 2 years in order to allow banks to focus on supporting lending during the crisis, given the substantial resources that are needed to implement CECL. That was their stated purpose in doing this. The banking agencies also issued a joint statement describing the interaction between the legislation and the regulatory relief, providing essentially simultaneous guidance to banks in setting expectations. Given where we are in the implementation process for CECL, as I mentioned, it was proposed or adopted in June of 2016. Not all banks are expected to take advantage of the option to delay full implementation. For some banking organizations, the process is likely largely complete and it's not possible or practical to reverse course and revert to the incurred loss method. But for some other organizations, the option to delay CECL implementation provides greater flexibility in addressing the effects of the current crisis. It's really an institution by institution question. Even before the legislation, state and federal banking regulators and other regulators took a variety of actions to address the emerging crisis, and I'll touch on just a couple very briefly. HUD Secretary Ben Carson authorized the Federal Housing Administration to implement an immediate foreclosure and eviction moratorium for single-family homeowners with FHA-insured mortgages for 60 days. The FDIC had issued guidance encouraging financial institutions to work with customers affected by COVID-19 in a prudent manner, and specifically stated that efforts to modify the terms on existing loan for affected customers would not be subject to examiner criticism. Going to the states, California Department of Business Oversight issued guidance encouraging financial institutions to provide accommodations and alternative service options to customers during the pandemic. And the New York Department of Financial Services issued guidance letters directing banks and mortgage servicers subject to the DFS's jurisdiction to work with borrowers. And then following the governor's executive order directing the superintendent of the DFS to do so, adopted emergency regulations requiring New York banks and regulated mortgage servicer entities to provide a process for New York residents to obtain forbearance on their mortgages. Regulators have also, I referred to this at the outset of my comments, have provided guidance that their supervisory and enforcement approaches will be modified or more flexible during the crisis, which should provide some degree of comfort to institutions working with borrowers to address the crisis. Mitch, I'll turn it back to you.
First, I want to point out the irony that isn't seen by anyone else other than me and maybe Camille in this. Camille always warns me, let's not let these things get too wonkish. So I, of course, asked her to talk about the wonkiest part of the whole presentation, but she did it brilliantly, notwithstanding its wonkishness. Having gone through the programs and the actions of bank regulators, the next part of our discussion is going to focus on different industries that may have access to programs under the CARES Act or through the Fed. And I'm going to ask 4 of our partners who focus on those industry groups to join us. Okay, let me start with Audrey Cohen and ask her, Audrey, among the various things you do, there's quite a list of them, you have done a lot of work with consumer and retail companies. And, if you're in the shoes of companies in those businesses, what are you thinking about now? Particularly while the details for some of the programs have yet to come out.
Thanks, Mitch. There's many sectors whose operations have been severely affected by this crisis, and also during this time, there have been big shifts in consumer behavior. And one noteworthy shift has been an abrupt swing in purchasing patterns. Sales of non-discretionary products such as food and household and personal care products have spiked, while sales of discretionary items such as apparel and furnishings have tailed off. If you consider the traditional brick and mortar retail companies who sell discretionary products, and many have closed their stores in the US and other countries depending on their footprint, as well as having closed distribution centers, warehouses, manufacturing facilities, and furloughed employees. Some of these traditional retailers had already faced pressure in their brick and mortar business as consumer habits pre-COVID-19 shifted to e-retail from physically going to stores, and these retailers have started taking or have already planned steps to address this pre-COVID trend, which could include plans to shrink their physical presence. Also severely impacted by COVID-19 and somewhat similarly situated as a result is the leisure and hospitality industry, such as fast casual and other restaurant chains and hotels and resorts. Rob will discuss the impact of this on landlords and REITs and other real estate investors, as many tenants have stopped paying rent or asked for reduced rent, but I'm going to focus on the retail industry. As discussed earlier, the B4 programs for both mid-size and larger companies don't exist yet. So the eligibility requirements and conditions are at the moment merely statutory suggestions. However, as the Fed may pick up on one or more of these requirements and conditions in its program when it launches in the next couple of weeks, companies should be preparing their information for eligibility, as well as analyzing the impact of the CARES Act on their business, including what it may mean for their business if the conditions are part of the program. If you want to pursue a loan or loan guarantee, moving quickly once the program's details are released will be important. So what should retail companies be doing now? First, I engage with counsel to determine and make a case for eligibility for the programs. One of the requirements will be a U.S. business requirement. However, it's important here to note that retailers with a non-U.S. parent company, but with substantial operations in the U.S., will also be eligible. So all companies should have their packet of basic information regarding their U.S. business ready. Things to include would be the number of U.S. employees, the amount of U.S. payroll, the number and location of stores, warehouse, distribution, and manufacturing facilities in the U.S., U.S. revenues, and other balance sheet assets in the U.S. The second eligibility requirement of adequate relief is making the case for how the company's not received adequate relief from other programs. So, for example, why it may not be eligible for some of the other Fed programs that Tom discussed that may require a certain minimum corporate debt rating, like an investment grade rating. And then also why, given the uncertainty of economic conditions, the loan request is necessary to support ongoing operations. So at a time when doors are shuttered and consumer spend has shifted, companies should be considering what are their various operating costs and pressures on cash flow, rent, payroll, amounts owed to suppliers and other vendors, inventory and raw material requirements, and in retail, considering the excess inventory as a result of the shutdown and how best to trim that, and a need for new inventory, for example, in areas like apparel. The second thing companies should be doing is engaging with counsel and tax advisors to consider the financial benefits of the CARES Act, as well as some of the possible operational limitations that may be imposed as conditions to the loan or loan guarantee. So, for example, quantifying the amount of tax benefits that could be available to the company as a result of the CARES Act and increased cash flow or refunds that could result. These benefits will be discussed in more detail in the webinars that we are hosting tomorrow and Wednesday, but include things such as payroll tax credit, deferral of payroll tax obligations, the ability to carry back NOLs from 2018, 19, and 20, and importantly for retail businesses and restaurants, the correction of the definition of qualified improvement property, which had substantially affected retail businesses and restaurants who had made improvements and will now be able to immediately deduct those amounts. Additionally, though, we need to consider and quantify some of the potential operational conditions, such as the obligation to retain and restore at least 90% of the workforce for a period of time. Retailers will need to consider whether this is consistent with projected operations when operating restrictions are lifted on their businesses. How and when will consumer behavior shift and at what pace? Additionally, were there other planned changes to the company's footprint that were in process or planned that this obligation could impact and at what cost? There are some other restrictions that were previously mentioned that will need to be considered, like share repurchases, restrictions on dividends, and executive compensation. There's also the potential condition that a company may not be able to outsource or offshore jobs for the term of the loan and for 2 years after completing the repayment of the loan. As there's no guidance as to what this condition means or how it could be interpreted yet, companies will need to consider what manufacturing or other facility closures or consolidations were planned or under consideration as part of their long-term strategic plans and what the potential cost of deferring those may be. And lastly, the other potential operational consideration could be the impact of the collective bargaining agreement and union organizing conditions that may be imposed. Third and lastly, things retailers should be considering now is working with their lenders and their counsel to review their existing debt documents. It's important to understand what's permissible under their existing facilities and also, for example, what collateral may be available for them to use. Also considering what may be the best type of facility for them and whether it can be done as an extension or add-on to their current facilities or should be a new facility. Given, the number of companies that are going to be seeking funds from these programs, being ready will be critical. Thank you.
Thanks, Audra. Let me turn to Rob, who works in the real estate industry, which, there are a lot of interconnections between retail and consumer businesses. And Rob, if I'm in the, not in the consumer business, but if I manage a REIT or I'm a landlord or I'm a real estate investor, how am I thinking about all this?
Thanks, Mitch. I'm going to echo a lot of the themes that Audra just mentioned. In specific terms, the CARES Act addresses no direct relief to REITs and other commercial landlords. However, some of the more generally applicable provisions of the CARES Act may benefit landlords. Depending on the nature of their businesses and other eligibility factors, some landlords may be eligible for assistance under the various previously described programs under the CARES Act, including receiving loans and loan forgiveness under the SBA-administered Paycheck Protection Program, as Rebecca mentioned. For certain landlords that own multifamily properties and have in place financing arrangements with Fannie Mae or Freddie Mac, Fannie Mae and Freddie Mac are offering borrowers impacted by the pandemic up to 90 days forbearance as long as they don't evict renters. In addition, the CARES Act may benefit landlords through the provision that allows non-corporate taxpayers to deduct excess business losses. Audrey had alluded to this earlier. Including some cases depreciation arising in taxable years beginning before December 31st, 2020. These losses were previously subject to a relatively low cap. Similar to the net operating losses carried back for corporate taxpayers, to the extent that a non-corporate taxpayer has filed tax returns for any taxable year beginning after December 31, 2017, without claiming a deduction for excess business losses, the taxpayer can now amend such tax returns and claim a refund. As Audra also mentioned, the stimulus also allowed lawmakers to fix a draft amendment on the 2017 tax bills, which made interior improvements for non-residential properties ineligible for bonus depreciation. Retail landlords and restaurant landlords in particular will now have the option to deduct 100% of the cost of such improvements in the first year instead of depreciating over several years. Apart from assessing eligibility for the options available under the CARES Act and pushing for additional relief measures from the federal government, various state governments, and other parties, landlord attention during the COVID crisis has been focused on the following areas. Number one, developing an effective communication and consultation strategy with tenants and other counterparties to ensure that these parties are aware of the resources and assistance available to them under the CARES Act and other federal and state programs, with a view to enabling these parties to continue to operate, pay employees, and pay rent. Second, working with tenants to restructure leases through payment deferrals, rent reductions, changes to the frequency of rent payments, converting fixed rent to contingent rent or profit sharing in some cases, and other modifications. Landlords have been inundated with requests for lease modifications from a range of tenants, from tenants under true financial pressure and distress to those acting more opportunistically. All tenants recognize that landlord remedies under leases are limited in many places by eviction moratoriums, closed courts, and other government and judicial limitations. And substitute tenants are not a viable option for most landlords under current pandemic and market conditions. Lease restructuring efforts started with the retail and restaurant tenants who were hit immediately by the various shutdowns across the country. Office and other commercial tenants seem to be quickly following due to reports of widespread rent non-payment for April. Next, with varying degrees of success and engagement, landlords are approaching lenders and seeking relief under various covenants, including financial and payment covenants, operating covenants, and leasing covenants. We expect interaction with lenders to greatly accelerate following non-payment by many tenants of April rent, as I just mentioned. More widespread and comprehensive loan restructurings are expected to follow very shortly. Landlords are also considering possible avenues for insurance coverage and closely watching possible legislative developments in many states regarding business interruption coverage. Several states, including New York, Massachusetts, New Jersey, and Ohio, recently have introduced legislation that would require insurance companies to pay out COVID-related business losses under business interruption coverage, notwithstanding, in many cases, contractual language that may explicitly exclude coverage when losses are due to a virus or pandemic. While the introduced bills require insurance companies to pay out under these policies, they also provide the insurance companies may apply for reimbursement from the state through various mechanisms. These legislations are subject to widespread discussion and commentary and still very much open in many places. Finally, landlords are watching carefully proposed legislation in various jurisdictions that would provide tenants with protection against eviction and other enforcement, rent deferrals, and in some cases, even a period of free rent. Many of these proposals would, if enacted, be highly problematic without a solution for landlords from their debt that is serviced by the applicable leases. Thanks, Mitch.
Thanks, Rob. Remaining in our program, we have two more speakers who are going to touch on other industries, and then we'll turn to try to answer as many of the questions as we've received. Or any questions that we received, there's plenty of time. Lines are open. At first, let me turn to Scott Miller, who works in a number of industries, but particularly in auto and aviation, and he's going to talk about how people in those industries should be thinking about these things. And Scott, if you could do us a favor and touch a little bit on the U.S. versus non-U.S. element of that and how it may play into things, that would be very helpful. Thank you.
Yeah, absolutely, Mitch. And first of all, let me start by extending, as others have, my well wishes for everyone who's on the call. There are over 600 participants listening on the call. We recognize that many of you have been directly affected, either with relatives or family members who are either ill with the virus or are healthcare providers whose efforts are truly humbling, and we recognize that, and our well wishes are with you. But let me turn to my piece of this, which is, I would characterize as planes, trains, and automobiles, maybe without the trains element. But a little bit about the aviation issues. And echoing some of what others have said, obviously the aviation industry has been one of the hardest hit by the response to the COVID crisis and the social distancing recommendations that all of us are following, as you can see us on our individual boxes here. And I think I just was looking at something last night that suggested that air travel is down 90% domestically and essentially shut off almost completely internationally. So the airlines and the related infrastructure are very hard hit. The CARES Act directly provides substantial financial assistance to the aviation industry, including grants for payroll support. Those are up to $25 billion for passenger air carriers, $4 billion for cargo air carriers, and $3 billion for air contractors, as well as some loans and loan guarantees. And Raj and Tom talked about the B1, B2, B3 programs, but the loan guarantees up to $25 billion for passenger air carriers and related businesses. Up to $4 billion for cargo air carriers and $17 billion for businesses critical to maintaining national security, and some of those would include some of these industries. I think it's important to think about some of the limitations, though, or the conditions on those programs that are important, because those grants and the loans contain some very significant conditions that companies will need to consider before participating in them, and in part because the normal response to difficult times is often to restructure or to seek consolidation, and those are obviously impacted by some of the restrictions that the Treasury and the Fed will be putting on these loan programs. So the notable conditions, both for the grants and the loans, or on the aviation industry, or the requirement for the Treasury Secretary, Treasury to receive warrants or other equity instruments. We talked already a little bit about the limitations on stock buybacks and dividends that will last until a year after the loans are no longer outstanding, or in the case of grants, till at least September 30th of 2021. And the restrictions on employment actions, so limitations in the case of grants on involuntary furloughs or pay reductions until September of this year. And in the case of loans, the requirement to maintain employment levels at least through the end of September that are within 10% of the March 2020 levels. I'm going to talk a little bit about in a moment about the application process, which is a little bit of a moving target. Mitch asked me to talk a little bit about, and Audrey had mentioned this before, about the requirement to be a U.S. business. I think obviously the U.S. business element of it, I think, was carefully defined in the CARES Act to include subsidiaries of foreign parents. I think we would obviously expect that as the regulations roll out and the loan programs themselves roll out, I think we can expect a little bit of ring fencing around the U.S. business as those loans are made. And as Raj mentioned at the beginning, I think most of those loans are going to be bespoke loans. And I think one of the challenges that all companies are going to have, which is why I would encourage everyone who thinks they have an eligibility for these programs to begin to think about that now and begin collecting information now, because these are likely to be bespoke loan programs. And given the other limitations, those of us who went through this in 2008 and 2009 will remember collecting in large conference rooms at the Treasury Department over days and days and days and nights to work out programs and to spend a great deal of time in working out the very specifics of the programs. It's not going to be possible to sit in those sorts of rooms, I don't believe, in the current environment. And the speed with which these programs are going to have to be implemented to have an effect are going to require an extraordinary effort to get done. It's looking at even the depths of 2008 and 2009 in some of the major industries. Take the automotive industry, for example, where the rate of auto sales declined by 50% and was deemed an incredible crisis, going from 16 to 17 million average sales per year to below 9 million. At the moment, those manufacturers, as most manufacturers around the country, are not producing any vehicles. They're effectively shuttered. So you're going from a 17 million in the auto industry, 17 million shipments per year to effectively zero at the moment. So it's a much more dire and immediate concern for cash flow for those companies, and it even was at the depths of the Great Recession. I want to spend a couple minutes, and then I'll turn back over to Mitch to just talk about the application processes. I think that we're hoping that in most of these, we'll know more hopefully today or tomorrow on what the application processes are like. Last week, the Treasury did issue some preliminary procedures on the loan applications and loan guarantee process for the aviation industry. We expect there to be something similar on the others. I think they are fairly detailed and fairly they're detailed and they require a lot of information that companies ought to be preparing now. One is the financial need, the requirement for a potential borrower, to detail their financial needs for the remainder of 2020. That's obviously going to be a difficult thing because not knowing how long the current limitations are going to be in place, to try to project that through financial forecast at the end of the year is going to be very difficult. And having to really be upfront about what the potential financial needs are, which are going to be tremendous for many of these companies. The second requirement, the absence of available credit elsewhere. Most companies, at least that I've worked with, have drawn their lines of credit to the extent they had them. It's obviously important that those lines of credit or other available credit be marshaled and obtained before turning to the Treasury or the Fed for funds. So that's something where you need to get the house in order. The other one, which is an interesting one, and is a little bit of a one where there's some tension in the process, which is a requirement to describe plans to restructure operations in order to reduce costs and improve the borrower's financial condition. As a normal lender, you'd expect any lender to look to the borrower to assume responsibility for reducing costs whenever possible. But a lot of the purpose of these programs is essentially not just to keep the company running, but to keep the industry running and keep the economy running generally. So the normal way of reducing costs, either to furlough or lay off employees, obviously is exactly counterintuitive to what the programs are intended to do. But also imposing costs on other participants in the industry, given the breadth of the financial resources that are being put to bear to this, is essentially just transferring costs to other parts of the industry, which will get picked up by other Fed programs. So that's something that, as we go through the process, we'll spend more time on. And with that, Mitch, I know we're sort of running out of time, so I'm going to turn it back over to you.
Thank you very much, Scott. For the final industry segment, I'm going to ask Matt Hurd to try to make a little sense out of there are a variety of provisions in the bill that relate to Medicare and other healthcare related elements. In addition, I'm going to ask him the question that that keeps occurring to me as to whether or not, if I'm in the pharma business, can I think about access to funds on a national security basis? Matt, if you could address those things.
So I'll end, Mitch, with my answer to that question. Getting back to Raj's opening remarks, we are working through the largest global health challenge that we've faced since the end of the First World War. The CARES Act contains very voluminous provisions supporting the U.S. healthcare industry, and it sets out 4 key themes relevant for business and relevant for us as citizens. Those are liquidity, relief, telehealth, and national security. In terms of liquidity relief, the CARES Act contains a huge number of Medicare-specific changes and modifications that are intended to deliver prompt and fairly effective emergency relief to U.S. healthcare providers. The healthcare, the Part A recipients, Part A providers, hospitals, Part B providers, most of your physicians will be entitled to request advancement of their last 6-month Medicare payment, which they will only be having to pay back in 1 year's time. After 120 days, they will start netting out these payments against ordinary course Medicare claims, which of course, given the crisis, will be very substantial. But this use of the Medicare statute and the use of the Medicare system will offer very powerful liquidity relief to healthcare providers of all types providing care for Americans and others. In terms of relief, the Act contains a $27 billion apportionment for the government's own response to the crisis, but it contains a $100 billion a transfer investment in paying off expenses incurred by eligible healthcare providers for COVID-related expenses. That's a $100 billion transfer into the U.S. healthcare system. We are acting on a pro bono basis for the principal New York hospitals, some of the California hospitals, and many other businesses, many other providers will be entitled to seek reimbursement of their COVID-related expenses. For the entities to whom we're offering advice, we're advising them to act promptly, act now, to pull the numbers together with the accountants and other consultants, and be prepared to act very quickly after HHS adopts enabling regulations to provide for the distribution of these funds, which it will do imminently. Has not done, but Secretary Azar's department will do it imminently. $100 billion for reimbursement of COVID-related responses by eligible healthcare providers. Third, telehealth. Most patients don't enjoy going to the hospital. Many doctors are very concerned, have always been concerned, but have become newly vocal about the epidemiological and immunological risks of having large numbers of patients in the doctor's office. The Medicare statute Medicare in general has historically been highly skeptical about the value, both therapeutically and financially, of telehealth systems, of visits and consultations with healthcare providers by means of a phone or a computer. That is all likely to change. The CARES Act contains a number of clues indicating that Medicare is loosening up on telehealth, and that new thinking is on the way in this area, and that's going to impact all of us. Standard physicals are much more likely to involve somebody in a white shirt against a blank background on a screen as they are a physical visit to a doctor's office. That's relevant to all of us. Finally, national health, the degree to which healthcare providers and med tech companies and certain but not many pharmaceutical companies are tied into the U.S. national security rubric has never been clearer. But the nexus is not reflective of the industry's historical position, reflected in, among other things, in its positions in the CFIUS arena, the regulations governing national security reviews of foreign acquisitions of healthcare companies. It is very clear that change is on the way, just arising out of the crisis. But the national security thinking will guide, to a certain extent, applications under in the B3 category that Raj and Scott were talking about, the national security funds. Those are likely to be bespoke cases, Mitch. I can't think of major providers who are going to seek are imminently in need of financing, given the other liquidity and relief measures I described. But applicability of the B3 funds to the healthcare industry will naturally be guided by our historic thinking on CFIUS and other matters, but importantly, lessons learned and concepts adopted in the B3 context will naturally shape national security review and other healthcare policy for decades to come. So that's it on healthcare.
Thanks, Matt. That was very insightful. As was, I think, everyone's presentation, at least from my perspective. I've learned a lot. I hope those of you who are listening have. And now, if I could bring back the whole panel, or if someone could bring back the whole panel, we have a number of questions that came in. We'll try to answer as many of them as we can. If there are others, feel free to submit. I did predict that there would be a number on the PPP, notwithstanding Rebecca's exceptionally thorough run through of it, but it's actually very complicated. So there have been a number of questions that have come through the system, just asking for a little more detail on eligibility, how you calculate the 500 employees, what's the affiliate rule look like, and one about Reg O, how Reg O applies. In that I can answer that Reg O, Reg O is there, but there are also a number of affiliation or association related provisions that are in the existing SBA regulations that people will also need to consider carefully in extending PPP loans to people who have relationships with the lending institution. But Rebecca, if you could try to, I'm going to, group them all together. If you could put a little more gloss on the eligibility requirements, that would be helpful. Mute.
My apologies. I will try to do that quickly, but I think you've also highlighted a point, which is that this program does have a lot of special characteristics, but it also draws upon a lot of the lore and knowledge applicable to the SBA programs generally. So to the extent you have SBA counsel, it probably does make sense to be in good touch with them to talk about the issues that are arising. But just to take a number of the questions, there's a question about how you calculate the 500 limit, the limit of 500 people. I think that, or at what point, the SBA has a regulation that normally would say that you calculate over a 12-month period the average payroll, including full-time, part-time, and other employees. Other would presumably include such things as contractors. That in connection with this program, they've given some informal advice that you look at the 500-person limit calculated as I just described, but on the day that the application is filed, I think that's because they're trying to get as many people in as they can, and the statute has some language that's a little bit hard to follow or apply under the circumstances. That's not, I agree with the person who asked the question, that hasn't been made public in a public document, but we've seen informal advice to that effect. Question also was raised, if you're limiting the program to 500 people and you can only apply their payroll, and their payroll is capped at 100,000 plus benefits, how do you ever get to 10 million? I think to understand that, you need to take into account that there are some entities, like restaurants, like franchises, that are able to aggregate far beyond the typical 500-person enterprise. And so in those contexts, you could, in fact, meet and exceed the $10 million cap with respect to those types of borrowers. The Reg O question that Mitch raised is an important one. Reg O does seem to apply, but there is an even more constraining limitation in the existing SBA regulations. Again, this is one where your typical SBA counsel may be important to consult. The conflict of interest rules under the SBA's existing programs do appear to apply. They were brought in by the interim final rule that the SBA issued through their standard operating procedures, and you do need to address those. Just a couple other questions, Mitch, shall I quickly before I relinquish the phone? Sure. Phone? Okay. Question about whether we're going to see draft PPP loan documents from the SBA. We keep hearing rumors that there will be some. It's not clear they'll be ready before banks are ready to fund. So I believe a number of banks are putting together draft notes, but I think we do hope that something will come out in time for funding. Question about whether the information about the borrower is public once submitted to the SBA. The answer is the identity of the borrower is. The SBA does make that public with or without a FOIA request, and some other information as well. I do not believe that the borrower's payroll information is made public, but I would not want to count on that without verifying that with SBA counsel. I think that is it. So, and sorry, the last question about contractors and advisors that are not on payroll, people paid on 1099. This is a difficult question because the statute suggests that independent contractors can be included, but the interim final rule is not quite as clear. It seems that the interim final rule is encouraging independent contractors to apply for themselves, which is permitted under the program, as opposed to the employer applying so that they can pay the independent contractor. Independent contractors are brought under the statute and their payroll is covered, or should be, if they meet the conditions, but that lack of clarity exists. But if independent contractors can apply for themselves. So I think that's the bunch, but I can come back if there's more after others are done.
Okay, thanks, Rebecca. Another series of questions are there about in the $454 billion provision in the CARES Act, there's an endeavor to use phraseology with respect to providing financing for mid-sized businesses. There's also the Main Street lending program that Tom and Raj talked about, and how do those interrelate? Do we see them as the same? Do we see them, obviously the statute has conditions. Will the Fed program have conditions? Do we anticipate? I don't know. Raj, maybe you want to start.
I'll be glad to start, and I think this is one of many areas which remain to be clarified. I think my expectation is that the mid-sized business and the Main Street lending facility, which also includes mid-sized business, will be placed together in a single program. And again, if you do the Main Street lending side of this, you have the opportunity for 13(3) loans as well to leverage the program and provide more dollars. And that's in itself, I think, a good reason to combine the two, as well as uniformity and simplicity.
Tom or Sam, you may have further comment on the topic. If not.
So this is Tom. One of the details that I think is an important detail relates to the funding that is used in the vehicles. And there were $85 billion in the Exchange Stabilization Fund before the CARES Act was enacted. and $50 billion was used for the Federal Reserve programs that were announced before the enactment of the CARES Act. So you can look at those Federal Reserve programs and say they didn't use appropriated monies in the CARES Act. With respect to the facility that Raj mentioned, the Main Street lending facility, that will likely have to depend upon some of the funds that were appropriated in the CARES Act, that $454 billion amount. And if it's a significant component of those appropriated monies, then one could argue that it's not exclusively a Section 13.3 program, but it relies on CARES Act authority, particularly with respect to the appropriation. If that's the case, then there is an argument, and we don't know how the argument will be resolved, that the restrictions in the CARES Act should come along with that funding. And we're going to have to wait to see the details to learn whether that particular program will be subject to CARES Act restrictions.
Thanks, Tom. With that, let me wrap things up so that we stay on time. We hope you found this all useful. I want to repeat the sentiments that have been expressed, that we at Sullivan and Crum will help you, your families, and as Scott rightly mentioned, all those providing care and help to those in need at this time, are well and stay safe and healthy. Clients have been asking a lot of questions about all of this, and in particular, they've expressed interest in a number of topics. There's going to come up on the screen a list of topics that we'd ask for all of you to sort of just vote on, in a sense, and tick off those who are those topics which are of further interest to you, because we're planning a series of these seminars over the next week or two, and we'd like to attune what we're doing to the needs that our clients have. So labor and employment is the first, global tax implications, crisis management, and litigation strategies and thinking. That's a little bit forward thinking perhaps, but important. The impact on M&A in the U.S. and globally, finance and restructuring aspects to the COVID crisis, and then opportunities that may be presented, but also difficulties in the capital markets in the U.S. and again globally. And if you would take the time to fill that out, we would be much appreciative. With that, thank you again for listening to us. Hopefully this was useful. If you have any other questions, please let us know and we will be happy to answer them. Thank you.